welcome to everybody this evening, and thank you for joining us, and especially our guest tonight, who will be looking at self-employment, capital gains, the 401k, the IRA, and capital income, pensions, and more. So everything to do really with taxation here in Portugal. And it's our very special guest that I'd like to introduce now from Conceito, Duarte Amaral da Cruz, to give you your full name. Duarte, good evening to you. Boa noite.
Good evening, everyone. Good evening, Carl. It's not my full name, by the way. It's just half of it.
Can we have your whole name then? Yes, that's silly of me. Yes, of course you've got more names than that.
You want me to spell my full name?
I would love that. Sorry,
sure.
Just although it is going to take quite a long time, but yeah, I'd love to. I'd love to hear that.
So it's Duarte Miguel da Fonseca Caramelo Amaral da Cruz.
Wow, I would probably not remember that. And at a dinner party, it's quite difficult, isn't it? If somebody does, if all the Portuguese people introduce themselves by their full names, that's going to be quite a lot to remember. So think yourselves lucky if you've only got one name to remember. Duarte,
the party would be over, right?
Right, yes, but by the time everybody's introduced themselves, yes. Duarte, if I may just call you that this evening, thanks for being
sure.
Let's go to your presentation now, where I suspect you'll be introducing yourself as well as all the topics that people want to hear about this evening.
Let's do that. I'm guessing that it should be visible now.
Looks great. Thank you.
Very well. So good evening, everyone. Some of you might know me from previous presentations, even though I haven't been very present in the last few months. I'm a tax consultant working for Conceito. Our specialty, my team's specialty is personal taxation. So we deal with several matters and several taxes related to individual taxation in Portugal, especially for people who come from expats, who come from other countries and they have connections with other jurisdictions. So my role is basically to advise them in optimizing and explaining how things are going to work out for them. This evening, I'm going to focus on the double tax treaty between Portugal and the United States of America. And I'm going to focus in five topics that Carlo already mentioned. And so without further ado, I'm going to jump to my next slide to give a general understanding about how the territorial competencies is determined under tax treaties, and in particular in this double tax treaty between Portugal and the USA. Usually the two main criteria to determine whether it's one country or the other taxing a certain type of income are the state of source and the state of residency. Ideally, the double tax treaties should allow that either one or the other is exclusively applicable, but that's not always the case. So sometimes we have some overlapping situations where both the state of source and the state of residency have territorial competency to tax a certain type of income. Nevertheless, the tax treaty should be able, and that's what happens, should be able to give a preference to one of the two states. The particular case of the United States, and this is not something exclusive from the double tax treaty with Portugal, it happens with other double tax treaties as well, is the taxation based on citizenship. This is something quite unique. And ultimately, this would never be a more important criterion than the two others that I mentioned. But it's rather a residual criterion that's going to be applicable to allow the United States to tax, even if the state of residency or the state of source is not applicable in their favor. So if there is any additional tax to be paid, the United States will always claim that additional tax if Portugal doesn't tax that full amount. So with this in mind, I would like to start going one by one and addressing these 5 types of income, which are actually more because, as you can see, inside pensions, we have different types of pensions. So we could technically be talking about 3 types of income inside one major category. And pensions are usually, as you can see in this first slide, they are usually categorized according to these three categories: public, governmental, and private. Just another one very important disclaimer is that this presentation will not include any reference to the non-habitual resident regime. So I'm going to be covering only the regular tax regime that is currently applicable in Portugal without the NHR. Let's see what happens with the NHR moving forward. But now I wanted to give a more realistic picture about how things look like without any special regimes. So private pensions are the ones that come from either previous employment or those from private investments. And we'll have a few examples of these with the 401k, with the IRAs, with the Roth IRAs. Those would all be included as a private pension. But then if we go back to employment, as a result of the employment, one could receive social security pensions, which would be public, and then other private pensions, namely contributions made by employers for different non-public institutions that create private pensions for people. And this is a major difference because the rules for the competency are different from private pensions and public pensions. So private pensions are first and foremost taxed in the country of residency, whereas public pensions are first and foremost taxed in the country of source. However, public pensions have one of those overlap situations I mentioned, where both the country of source and the country of residency might claim competency. So it's actually up to the taxpayer to determine where the taxes will be first paid. And this is unless, of course, the Social Security makes any sort of withholding tax, because then the tax is already paid at source, and then the country of residency will only be able to claim the difference if there is any. Other than these 2 types of pensions, we also have governmental pensions. And this is something also specific from this double tax treaty between Portugal and the United States. I'm assuming that the United States also have this clause in other double tax treaties, but tax treaties between Portugal and other countries don't commonly have a specific clause for governmental pensions. This is probably something related with the fact that each state in the United States has a different set of rules, and therefore we have situations where people might be working for the university, the public university of one state, and this pension would be considered a governmental pension. Other frequent examples are military pensions and similar pensions. All those are taxed not first and foremost, but exclusively in the country of source. So Portugal will never claim any taxation, or at least that should not happen on these governmental pensions if they come from the United States. In this slide, I also included the general tax rates that are applicable for all these pensions that are taxable in Portugal. These tax rates will also be relevant in relation to other sources of income, even though I'm not going to be repeating. I'm not going to be using them in any other slide. And now, to complement this understanding about where the pensions should be taxed, I thought it was interesting to give you some raw numbers and some examples of how different pensions will work And that's why we decided to come with these calculations. The amounts are obviously arbitrary, so we just went with these numbers. We could use lower numbers, higher numbers. It really depends, and it will make a difference because of the progressive tax rates and how they work. But my main goal here is to lay down the difference between a regular pension like social security and regular private pensions, and the 401ks and the IRAs, which are usually which are very frequent from people coming from the United States. So I'm frequently asked about how they work, and it seems to be a very relevant topic. So we thought it was a good idea to include both calculations. So at my left, so starting at my right, I have private pensions, and for that purpose, public pensions will have the exact same treatment, with the difference being if they are taxed at source, the tax that was paid in the United States will work as an international tax credit in Portugal and will be deducted from the final assessment as we have it here. And basically, private pensions and public pensions will be 100% taxable. They have an automatic deduction of 4,000 euros, roughly. So in this example, for a private pension, an annual private pension of 100,000, we would have approximately 36,000 euros to pay as personal income tax, which is obviously a 36% effective tax rate. This estimation does not include any deductions, any other deductions that might be applicable, such as health expenses, education expenses, and other deductions that exist in our tax system. At my left, I have the 401k and the IRAs, which, according to our interpretation, are exactly the same thing. And they work rather differently because they start with an assumption from the government that 85% of the amounts that are withdrawn from these from 401ks or IRAs are actually the investment made by the taxpayer. So what happens is that these 85% are excluded from taxation, and the progressive tax rates will only be applicable to 15% of the gross amount. Obviously, this will result in a very low tax rate, and you have the numbers here. So it will reduce the tax bracket and ultimately the amount of tax that will be payable. So this is a very important difference. I know that some people have a different interpretation in terms of how to tax 401ks and IRAs. Our interpretation, and it's a strong one. It's supported by law. It has a specific legal provision. So this is how we treat the 401ks and the IRAs, and so far we have no indication that it's wrong. But laws and taxes, there are always different interpretations. That's something common. The only thing that we know for sure is that we're going to pay taxes. So that's one thing we know.
Yes.
Moving forward, we have capital income, and I'd like to take a moment to distinguish capital income from capital gains. We'll talk about capital gains later. Capital income basically encompasses interest, dividends, and similar sources of income. Capital income in Portugal is usually taxed at a flat 28% tax rate, because more often than not, this is better than the progressive tax rates. Nevertheless, it's possible to choose the progressive tax rates if they result in a better tax payable for the taxpayer. This is another example of a source of income that can be taxed either at source or residency. So basically, if there is no withholding tax, the country where you first file is the country where you are going to pay the taxes. And then you file in the other country, and if there is any additional tax, you'll have to pay the difference. So if you only, in a world where you only have dividends and interest, you will have to figure out where you're going to pay the lesser amount of taxes if you want to split the taxes between one country and the other. Otherwise, you're going to pay everything in one country, and then there's nothing left to the other country. I wouldn't say people worry much about this, but it's something to keep in mind when filing the tax returns. As I said, the 28% is an alternative to the progressive tax rates. In this example of 85,000 euros, we can clearly see that the 28% is more favorable than the progressive tax rates. And then and this is not directly related with the double tax treaty, with this double tax treaty, but we know that people, even a US citizen, it's not mandatory that the only source of income is the United States, right? So it's possible that investments are made in other countries, and therefore we thought it was interesting to call your attention to the fact that capital income coming from blacklisted countries will be taxed at 35% in Portugal, and you have no alternative to this. So it's always 35%, and that's how it goes. As I mentioned, capital gains are a different animal. They correspond to the gain you make when selling either a property or a security. So we distinguish both because they are actually different, in the sense that capital gains on real estate, they are taxed first and foremost in the country where the real estate is located, and that makes sense. And that country, regardless of the order in which you decide to submit your tax return, that country will always claim their full tax, and it's very unlikely that they will give a tax credit to the tax paid in the other country. So if in any given year you have capital gains on properties, you should file in the country of source first and then the country of residency. Otherwise, you could be double taxed, and then it's more complicated to get your money back. On the other hand, capital gains on security, they are taxable in both, but there's no specific order, so you can be free to file your taxes in one country or the other first. I'll give you some time to process this, and I'm taking a sip of water as well.
Blame you. Thanks for all the questions, everybody that have come in already. We'll make sure we get as many of those in the first half hour as we can to Dwelt, and any we don't manage, we'll do in the subsequent half hour, which won't be broadcast on YouTube and won't be recorded. Okay, back to you, Dwelt.
Thank you. So the taxation of capital gains on properties is actually very particular, because the rules applicable in the United States and in Portugal are very, very different. In the United States, some amount of capital gains is not taxed at all. In Portugal, this doesn't exist. On the other hand, in Portugal, only half of your capital gains are taxable. So it's quite intriguing to learn the calculations and how to declare them, how to adjust them. Sometimes it's not crystal clear how you have to declare your income in this specific case. We brought you an example of a capital gain of 450,000. As you can see, only 225,000 are taxable in Portugal, and progressive tax rates are always applicable to capital gains from real estate. So the 28% I mentioned before, it's only applicable on securities, stocks, etc. So whatever capital gain you have to cut it in half and then subject to progressive tax rates. Here we would have an effective tax rate of 21%, which is not bad, considering that the capital gain is quite significant. We also choose this number, this amount of capital gains, because if my understanding is correct, this type of capital gain would already be taxed in the United States. So it would be a relevant number to make this comparison. On blacklisted countries, the situation changes dramatically because the 35% are applicable to 100% of the capital gain. So do not buy properties in Cayman Islands or Seychelles, because then you're going to pay a lot more taxes than you would otherwise. On securities, like I mentioned, 28% is the most common. Progressive tax rates are also and are always available to the taxpayer. There are, however, specific circumstances which are quite complex, so I'm not going to go into much detail. But under those circumstances, the taxpayer might be subject to mandatory progressive tax rates. This only happens with short-term operations, and this only happens if the taxable income subject to progressive tax rates is higher than 80,000 euros, roughly. Okay, so it's something created to fight speculation and people who are trying to speculate and have significant gains in trading, because theoretically those people should probably be considered traders. So this is an alternative that the tax authorities or the government in Portugal created to fight these short-term gains. We could also talk about cryptocurrency and crypto actives in general. Those are also subject to different rules, because if you hold the asset for more than 1 year, it will always be exempt. So for a long time, cryptos were not taxed in Portugal at all. Recently, in I don't know, in 2023 or 2022, the government decided that they would be taxable, but only if they are short term. So if you hold them for more than 1 year, then it's not taxable. You do have to declare them, which is a lot of trouble. It's challenging, but it's possible. It takes a few hours, but it's possible. If you are doing short-term operations, you not only declare them, but you also pay 28% tax. Okay. We also made some calculations about the progressive tax rates on securities, just to let you know that you would pay more than the 28% in a similar situation to this one with 95,000 euros. Self-employment. I believe this is the last type of income, and I saved it for last because it's the most confusing. Usually people think that capital gains are the most complex, and they are, in terms of calculations, in terms of the amount of work we have. But self-employment is very complicated in the sense that the source is outside of Portugal. If the source is outside of Portugal, it will be considered foreign source, but it will be 100% taxable in Portugal. So the country of residency is the applicable criteria. But then here is where tax residency is more important, because usually the double tax treaty for any other source of income that I mentioned before, in some way, the double tax treaty will handle double taxation. sometimes more efficiently than others, but it will always be the case. With self-employment, if you don't change your tax residency, if you are tax resident in both countries at the same time, and if you earn self-employment income will be 100% taxable in both countries. So you will effectively be double taxed. Because none of the two countries will acknowledge the international tax credit from the other country. So it's pure country of residency, but at the same time, the source is never Portugal if the client is not in Portugal. So it's quite confusing. To make it simple, if you live in Portugal, you pay everything in Portugal and that's it. But technically speaking, it's quite complex to sometimes explain this to clients because they get tangled up in this not so efficient system. In Portugal, self-employment will be subject to progressive tax rates. But before that, and in order to determine the taxable income, which is never 100% of what you earn, so it's never the gross income. There's always some percentage of deductions, which we called coefficients because that's what the government decided to call them. So first we need to determine the activity in order to determine the coefficient. After doing that, we apply the coefficient, which will exclude a percentage of your gross income from taxation. And then we have some room to wiggle in terms of professional expenses that can further reduce your taxable income. For the majority of employment income, especially freelancers, contractors, however you prefer to call them, the applicable coefficient will be the 75 coefficient, the 0.75, meaning that best case scenario, 75% of your income will be taxed according to progressive tax rates. The 0.35 coefficient is often applicable to short rental. It's the most common example. And this means that 50% of your income, of your gross income, is not taxable. And then you have a room of 15% to reduce it to 35%. So that's your best case scenario. Best case scenario in option 1 is 75% of taxable income. The second one, 35% of taxable income. And I told you it was not going to be simple. So here we have a bunch of numbers, which I will try to simplify. On top of everything I said, the first year registered as self-employed in Portugal will grant the taxpayer a 50% reduction of the coefficient. So now we have yet another operation to determine the taxable income. And that is visible here with these two examples. 150 of gross, 200,000 of gross income, which with the 75 coefficient would reduce the taxable income to 150, but then the 50% reduction will reduce it to 75% in the first year. In the second year, it would reduce it to 112. The same thing is true for the other coefficient, but the numbers are lower, considerably lower, because usually the government presumes that in order to have a short rental, you need to incur in a lot of professional expenses and in general costs with the property, and I believe that's one of the primary justifications to use such a low coefficient as the 0.35. Both are subject to progressive tax rates, like I mentioned. So you can see the difference of the first year and the second, between the first year and the second year of activity. Then the third year will be worse than this. So I didn't bother bringing that to you because I don't want to depress you. So I tried to be optimistic. And I guess in terms of presentation, this was all I had to say. So I hope this was useful. I know it's a lot of information. I'm sorry if I didn't express myself as well as you'd like, but I guess we'll have the opportunity to clarify some of your questions in the following session. So thank you all for coming.
Thank you, Duarte. You did a great job, and it's not possible to present such information in a very clear, upbeat, and simple way. It is complex, isn't it? And you've done a fantastic job in articulating what people are up against here. And of course, you can be found in the Expats Portugal Business Directory if people want to pick up with you and get your help on an individual basis. And as you said, we have a Q&A now. I just need to turn off the stream to YouTube. So I'll finish your share. Oh, that's great. Okay, so we've stopped your sharing there as well. So thanks, Duarte. Really appreciate you being here tonight and sharing that with us. And just to let people know, over on YouTube at the moment, to become an Expats Portugal premium member, because that's where you'll be able to hang out with Duarte now and ask those more personal questions. And I'll get to as many as I can that are in the chat for now. So just turning off the stream over there. Thank you for joining us. And let's come to let's turn off the recording here. So yeah, thanks again for being here. And
thank you, everyone.
You can, of course, be found in the Expats Portugal Business Directory for further help and personalized one-to-one help.